Good morning, everyone. Thank you all for taking the time to join ATRAM's market update for today. I am Reynal Ngo, Equity Analyst at ATRAM. For this webinar, we have invited our portfolio managers with decades of experience in the market who have weathered past crises to help update us on the latest news and insights surrounding the market. I'd like to introduce our three speakers this morning: ATRAM's Chief Investment Officer, Mr. Philip Hagedorn; ATRAM's Head of Equities, Mr. June Tarrobago; and ATRAM's Head of Fixed Income, Mr. Miguel Liboro. After their talks, we will have a 10-minute Q&A session for our viewers. Viewers, if you'd like to submit questions, you can do so throughout the discussion by clicking on the Q&A button found below your screens. You can also choose to ask a question anonymously in the options. Now, before we begin, please take note that this webinar is being recorded and that copies will be sent within the day and posted on our social media pages. All right, let's kick things off with a brief assessment of our economy's outlook by ATRAM's Chief Investment Officer, Mr. Philip Hagedorn.
Thank you, Reynel, and good morning, everybody. Thank you once again for joining us today. We're very happy to have you on board with us today. I'm not going to spend a lot of time. I just want to update everybody on things we're looking at with regards to the virus update. We think this is a very, very important week. This is the week that we will begin more testing. From the data that we've seen, as of last week, we were testing an average of 1,000 people a day. And we've ramped that up over the last 2 days to an average of about 3,000 per day, which means that over the next 5 days, potentially we'll be testing 15,000 people. And we very much expect the number of infections to rise by at least 2,000 people over the next 5 days. So any number of new cases at or below 2,000 would actually point to some good news as far as trying to put this under control. And so we're watching these numbers closely. I think the big implication will be how quickly this expanded quarantine lasts. And I think you'll get more guidance from both Julian Tarrobago and Miguel Liboro later as far as what our expectations are with regards to this quarantine period and when we think the economy and companies can begin to move back towards normal operations. So with that, I will leave you to the discussion of June and Miguel. Again, I want to thank you all for participating and joining us today. Please leave your questions. If we can't tackle them at the seminar or webinar level, we hope to be able to address them individually and post them on our website in the future. So thanks again for joining us, and good morning, and stay safe, everybody.
All right, thank you, Phil. Now let's transition over to an update on the global and local fixed income markets by Mr. Miguel Liboro.
Hi, good morning, everyone. Thank you for joining us again today. I hope you find these views and insights useful in your investment decisions. And if you leave with nothing else today, I'd like you to leave with one clear message. Yields in Philippine bonds will be going lower. Now let's talk about why. Next slide, please. Oil prices remain volatile, but are likely to stay low. After a brief recovery, prices have dropped once more and are trading around their year low levels of $20 to $30 per barrel. While we anticipate that these levels may move higher, we certainly don't think that there's a case for a pronounced spike higher. So we think inflation is moving lower. We've been observing some movements higher in food prices as we've been stocking our pantries and refrigerators, but access to goods appears to be decent considering the situation. And government controls already implemented on the prices of staple goods appear to be working, as evidenced by the recent downward trend in inflation throughout the first quarter of the year. But what about non-essentials once this initial broad lockdown ends in 2 weeks? How many of us intend to hit the clubs or head to a movie theater or enter a public gym or really do anything that requires us to be in close proximity with a large amount of strangers when we don't really have to be? Lockdown or not, this pandemic will continue to affect consumer discretionary habits, at least in the short term. And if you haven't bought that heavily discounted TV online over the last month and a half, what are the chances that you're going to do so in 2 weeks' time at the store? These adjustments are likely to cap any meaningful adjustment higher in the price for non-essential discretionary goods and act as another indicator that inflation is likely to stay low over the medium term at the very least. And this is supportive of, as I mentioned earlier, our view for lower interest rates. Next, please. The BSP has been very deliberate in their actions, and they have a lot of room to move still. They cut the reserve requirement rate by 2% already, taking us from 14% down to 12%. They've also indicated their intent to cut it down by another 2% to 10% before the end of the year. Now, just to put that into context, each 1% cut on the reserve rate introduces an estimated 90 to 100 billion pesos worth of liquidity into the broad market and into the broad economy. In addition to that, they've this year cut the overnight policy rate from 4% by 75 basis points down to 3.25%, where we are today. And based on our view and comments received from BSP Governor Diokno over the long weekend, it does seem that there is room to cut further. And we anticipate another 2 to 3 cuts at least for the balance of the year, with at least one of those cuts likely to occur over the next month or so, taking us below the 3% level on the overnight rate. Additionally, there was some criticism initially with the market saying maybe the BSP hadn't acted quick enough. But I think that this was really more when being compared to the US Fed. Now, as we know, the US Federal Reserve acted quite aggressively. Over March, they cut their overnight policy rate by 150 basis points down to 0. And I guess initially, a lot of investors were thinking that there may be a commensurate response locally. When the BSP did not cut to that extent, there was the fear that we weren't acting fast enough. That fear, I feel, has since dissipated. The BSP has since showed the willingness and the ability to act and demonstrated that they have a variety of tools in their toolkit still. Not the least of which was two weeks ago when they announced their limited bond buying operations for up to 300 billion to support the local market and to reintroduce liquidity into the market. In this way, they were able to stabilize the yield curve, which I'll get into a little bit later. But by acting in a more circumspect manner, they've ensured that they still have dry powder in order to address the COVID-19 situation should the situation deteriorate further over the balance of the year. Otherwise, if we had thrown the kitchen sink at the problem now, we may not have any ammo or firepower in terms of monetary policy later on. So again, the recent actions of the BSP and our projected future easing actions are also supportive for our view for lower interest rates. Next slide, please. The Bureau of Treasury has received a lot of support from the BSP. Now, whether or not they have been in explicit coordination is besides the fact. With their targeted bond buying program, the BSP was instrumental in stabilizing investor sentiment, as I mentioned earlier, and managing the yield curve over March, when broad negative sentiment across asset classes, both globally and locally, caused yields in the local fixed income market to surge higher by over 1% at their peak. By providing liquidity in the market, they bolstered investor sentiment, gave the BTR the flexibility they needed to manage their issuance program during their weekly T-bill auctions and their bi-monthly bond auctions. In addition, even if we project additional borrowings moving forward in order to fund programs targeted at combating the negative economic effects of COVID-19, the recent and likely future liquidity injections from the BSP should be more than sufficient to offset any increase in volume of issuance. In simple terms, this means that there will likely still be more money or liquidity in the system and thus more likely demand for bonds than there will be an issuance or supply of it, even if this supply is to increase. Again, also supportive, I believe, of our view for lower interest rates. Next slide, please. Fixed income is largely an assessment of relative value. And there's been seldom a clearer argument for the relative value of Philippine yields than there is today. Now, I'd like to call your attention to this chart. It's a 5-year chart with the 5-year low of the 10-year liquid government Philippine bond in 2016 at around the 3.1% level. Now, the long-term average spread or difference between the 10-year US Treasury and the 10-year Philippine bond is around 200 basis points or 2%. 2 weeks ago, this spread was, as you can see over there, closer to 420 basis points. That was more than double its historical average. For us, that was a screaming argument for the valuation or the undervalue for the Philippine bond yields, the undervalued, and yields being just simply too high. And it appears the broad market is catching on because over the last week and a half, that 420 basis point spread has since tightened by 70 basis points and is now at a 350 basis point differential. We expect this spread to tighten further as US Treasury yields remain low, but as Philippine bond yields move lower to close that gap. For all the reasons mentioned earlier, and because of this relative value dislocation, which we feel is unwarranted, given the Philippines' reasonably strong fundamentals. In fact, one might say that given everything that's happening in the world, the Philippines, while adversely affected along with every other economy, is perhaps in a better position to withstand or be resilient in the case of future stress, because we do not have a large reliance on exports. Our currency has actually been a strong outperformer recently in both the EM space and the Asian space as well. And as I already discussed in some detail earlier, we do have ample room left in policy to be able to make any necessary adjustments in order to support our economy. Next slide, please. So we've discussed in some detail the factors that we feel support our view for lower rates over the balance of the year. And now, if you'll allow me a bit of a shameless plug, we feel that the ATRAM Total Return Peso Bond Fund would be an ideal way to take advantage of this market environment. Now, just going very quickly over some of its short-term performance. Year to date, the fund has delivered a positive return of just below 3% as of April 14. And this is against a backdrop of largely negative asset classes, both locally and globally, and with a much lower range of volatility as well. So in terms of the usual correlation for fixed income and investment grade fixed income, specifically referring to nations like the Philippines, holding a bit of a haven status in this time of economic and financial market upheaval, that correlation is still very much in play. The balance of risks continue to provide a very compelling argument for both existing investors in these strategies and for prospective investors as well. Just as a case in point, given all the factors we've already discussed on why we feel rates will continue to move lower for Philippine bonds, you also still have that spread tightening between the 10-year Philippine bond and the 10-year US Treasury bond. Given everything that's happening, we don't think that rates on global bonds such as US Treasuries will be going higher. But we do think that yields on Philippine bonds will be going lower. from 420, we've already moved to 350. And while I'm not necessarily saying that we're going to go back to that 200 basis point spread, I do believe that we will be moving significantly lower from current levels. Simplistically, and if you'll bear with me for the a bit of an oversimplification and a return estimate. The 10-year Philippine bond has a duration of 7. Duration is defined as the interest rate sensitivity of a bond. Now that means that if rates move down by 1% from current levels, meaning if we move down on the 10-year bond from 4.1% to 3.1%, that means that anybody holding a 10-year bond makes a return of 7% on price, even before factoring in accruals received. Now, even if we don't get to that 7% return, the chances are that we make a large part of that are quite significant. And that's actually why we positioned our portfolio in such a way. I'd like to call the attention to the metrics presented in this graph, where the duration of the ATRAM Total Return Peso Bond Fund at present is at 7.85, higher than the 7 that I just mentioned as an illustration. And this reflects our view that rates will continue to move lower in this environment and that we are positioned accordingly. Further, I'd like to draw everyone's attention to the table on the bottom left of this slide, highlighting the long-term or 5-year performance of the fund in both negative markets, such as those we saw in 2016 when we were afraid of a China-led global growth recession situation, or in 2018 when inflation surged to levels of above 6%. The fund has a track record of being able to protect on the downside, but generate gains in a volatile environment, such as this one. Additionally, when compared to the broad Philippine benchmark index or riskier asset classes, the fund has been able to outperform amid lower volatility. So there is a place, I believe, for fixed income in anyone's portfolio, especially given the strong case to be made for returns this year. Thank you very much, and I'd be happy to take any questions later on.
Thank you for sharing your thoughts, Miguel. Once again, let me remind everyone to please continue asking your questions using the Q&A button found below your screens. These will be answered by our speakers in the Q&A session later. Moving on to our next speaker, I'd like to pass the mic over to Mr. Julian Tarrobago to discuss his stock market outlook.
Morning, everyone. There are decades when nothing happens and weeks when decades happen. It's a saying from a famous leader of the Soviet Union. I think it's quite relevant for what we're seeing in financial markets today. The COVID-19 health crisis has mutated into a full-blown economic recession as broad restrictions on movement, consumption, and trade has brought first half economic activity to a grinding halt, or is moving it to a grinding halt. Compounded by the massive drop in oil prices, this has plunged global stock markets and the PSEI into turmoil. And we're seeing what is shaping up to be the fastest and strongest period of panic selling in history. In the US, the S&P 500 moved from its peak into bear market territory in a matter of 16 days. Quite fast. In the Philippines, while we are just starting mass COVID-19 testing, we understand things potentially get worse before they get better. We also believe the Philippine economy is not broken and actually remains quite strong. Government stimulus packages appears, I think Miguel talked about this earlier, government stimulus packages appear significant at about 6% of GDP. And our base case is still for a rebound in the fourth quarter of 2020. Meanwhile, however, indiscriminate selling has resulted to massive price dislocations in Philippine stocks that present both high quality, deep value opportunities for investing in stocks, and at the same time, value traps or companies to avoid. Some value traps can even be part of the PSEI but contain massive earnings downgrade risks and will be relatively and very slow to recover. As such, we think these conditions present us incredible opportunities for active management. And I would like to share with you how we have and will continue to navigate through these challenging times. Hard to predict exactly how and when things will pan out. So we look at scenarios. That's our guideposts in our compass for navigating these hard times. So we've looked at V-shaped scenarios, U-shaped scenarios, L-shaped scenarios. Some even say J-shaped scenarios or W-shaped scenarios. But we've pretty much narrowed it down to three basic scenarios, and we'll talk about how we've mapped that in the latter part of this webinar. And of course, ultimately, what is the impact on the Philippine economy, and what is the impact on industries, and what is the impact on stock prices in general. So next slide, please. So the next slide shows indiscriminate selling and panic selling has hammered the PSEI down to 2009 crisis levels. The PE of the market has dropped towards 10 times. At its low, it was, I think, 8 times or 7 times PE. So this is a level at which we were at during the worst financial crisis in history, which was 2008 and 2009. And so that's on a PE basis. The chart on the right side of the screen is the Buffett ratio, or the market cap to GDP chart for the Philippines. And this is a chart, the market cap to GDP, or more popularly known as the Buffett ratio, takes out the distortions in the simple calculation of the PE, takes out non-recurring items, and other extraordinary items that distort the PE numbers. So we think during periods of big price dislocations, big price swings, the market cap to GDP ratio is a reliable source of gauging value, or whether a market is expensive or inexpensive. It also takes into account the size and improvements made in the economy. And the chart on the right again shows that the market cap to GDP ratio of the Philippines has actually breached at some point levels at which we were at during the 2008-2009 crisis. Because of the sharp rebound over the past days, it's above that a little bit. It's gone above that recently. So we are still at crisis levels. Do we deserve to be at crisis levels? If we take what the stock market is telling us, the stock market gives us not just the information that's in the market, it also gives us a strong sense of the emotion in the market. And now it's fear. A little bit of euphoria recently because of the rebound in the market, but it's still dominated by fear. The market is still down close to 30% on a year-to-date basis. Next slide, please. So while stock prices are telling us that the economy is in bad shape, we are in for a long period of recession and all of that. This chart shows you that the Philippine economy is actually in very healthy financial shape, and this fundamentally gives us confidence that the markets, the economy and the market and share prices will rebound considerably towards pre-COVID-19 levels. The question is when, so we'll talk about that a little bit later. So the slide shows that most importantly, that the gross international reserves of the Philippines, or the dollar reserves of the Philippines, actually higher now than the external debt position of the Philippines. So that's quite significant in our view. It's always been, in the early part of the decade, it's always been below the external debt of the country. And right now we're in pretty good shape. The S&P credit rating of the Philippines has improved considerably to BBB plus from BB minus, I think, last time. GDP per capita has twice improved to almost $8,000 from 5,200. Government to GDP, leverage of the government is improved downward to 42% currently, as compared to about 55% back in 2009. So pretty healthy economy. We will see I think it's safe to say we are going to experience a recession in the first half of 2020 with regard to the economy. From an earnings standpoint, our simulations actually derive a 6% contraction in corporate earnings for 2020, given the weak first quarter, second quarter, potentially third quarter numbers. And the slide shows that in terms of the impact on corporate earnings, infrastructure, aviation, and industrials would be adversely affected. You have delayed projects. Obviously, the airlines flights will be adversely affected. Banks will also be impacted negatively. We anticipate the economic disruption to result in an uptick in consumer and SME NPLs, or non-performing loans. So asset quality issues might surface for banks, and credit costs and slower loan growth for 2020. Real estate, particularly in the accommodation space, will be impacted, will be most affected, while residential sales could slow down and launches will be scaled back. You could even see cancellations in terms of pre-sales for the property companies. For gaming, obviously, our view is that based on the lockdown, this sector will likewise be adversely affected. Tourism-related sectors would be adversely affected. Consumer, at least for the next 2 months, consumer discretionary is probably going to be hardest hit for the consumer names in the consumer sector. Retailers in particular will be experiencing close to zero sales during the lockdown period. On the other hand, you have staples and telecommunications companies presenting relatively more defensive plays. Consumer staples are seeing a surge due to panic buying in the second quarter. However, we note that supply chain disruptions might temper gains for consumer staple companies in the consumer staples segment. For telecommunications companies, probably the biggest beneficiary of all of this. I mean, mere fact that we're on Zoom and using our data on a daily basis, people getting hooked on data, is a positive for telecommunications companies from the increase in fixed line broadband revenues and data volume for people working from home also. And we also think that this could push back the entry or delay the entry of the third player, Dito. Not sure how significantly delayed that will be, but intuitively there will be some delays there. On the next slide, where to next? Our view is, because of the health of the economy and because of our base case scenarios later on, we'll show you. Our view is that it's not a question of will or if the Philippine stock market will recover. It's more of a question of when the stock market will recover. And our looking at past crisis, the wisdom from being in the market for a quarter of a century, every crisis is different, but there are commonalities in terms of how market phases pan out. And usually when there is a crisis-like event or a crisis shock, such as this one we're experiencing right now, as an investor, you want to look for peak periods of panic, which has been historically, at least over my 25 years of experience, a good indicator of understanding or getting a sense of where market bottoms may be. We think the volatility will continue, and we may see a peak panic period within the next 4 weeks. And peak panic and the bottom of the market will likely be characterized by one, peaking easing of COVID-19 daily infection rates, global manufacturing indices bottoming out, and three, when we see clear-cut easing, fiscal easing on the part of government, and we're seeing that now. I think 6.6% of GDP is significant. The question is how efficiently the stimulus packages are delivered to those most in need. That is something we're monitoring very closely, and we're rooting for the government in terms of doing that. And of course, peak panic will probably be reached, or the bottom is probably behind us if and when a vaccine is announced. But that's probably less of a possibility near term, and we're looking at the first three factors: the COVID-19 infection rates easing, rebound of manufacturing PMIs, and clear-cut fiscal easing as strong indicators that the market is nearing its bottom. And then again, our assumption is weak GDP and corporate earnings for the first half, a recovery in the fourth quarter of 2020 on account of an anticipated recovery in domestic demand. Not full recovery, but a semblance of recovery. Continuation of accommodative monetary policy, and resumption of infrastructure spending, most likely next year, or latter part of this year. We also see structural improvements in the economy, from potential sharp reduction in the corporate income tax rates of corporates. In the past, they talked about 100 basis point reduction in the income tax rate per year over the next 5 to 10 years. What we have heard is that there is on the table 500 basis points in potential corporate income tax cuts. So this is structural and will be embraced by investors. Also, there is the potential lifting of foreign ownership limits on most industries, except I think 4 industries. And then, of course, the start of the REITs, or the real estate investment trusts law being passed, and I think Ayala Land hopefully starting the trend there. They, I think, are coming out with a first street in June this year. Hope that pushes through. And of course, crisis valuations for pretty hefty for the market still, despite the recent run-up. We still have significant upside on the market. We're not saying, but I guess it's important to note that we still will experience considerable volatility in the market, and that's something we need to take into account when we formulate and implement our individual investment strategies. So, next slide, please. So this slide shows market scenarios. And let me just increase it a little bit. So in order to navigate these, like I said earlier, it's very difficult to try and understand or predict what is going to happen and when things are going to unfold. So we think in terms of, our approach is to think in terms of scenarios. And in this particular case, in this slide, we have 3 scenarios. The U-shaped recovery. So we think the recovery, all based on the shape of the recovery. So the U-shaped scenario is, and then you have a V-shaped scenario, and then you have an L-shaped scenario. Let's start with the L-shaped scenario on the rightmost part of the slide. So the L-shaped recovery scenario implies a peak in the infection rate after 10 weeks and over a 4 or more month lockdown, and then ineffective execution of government stimulus measures. It also assures bank NPLs rising to double digits in 2020, and possibly bankruptcies and defaults surging. No vaccine to be discovered or announced, and the Philippines vulnerable to secondary or tertiary outbreaks CapEx is for corporates will be suspended indefinitely, or suspended indefinitely. That's the worst case scenario. And then the V-shaped scenario is more or less the best case scenario. Under the V-shaped scenario of recovery, the assumptions are infection rates peak within the next 2 weeks, 2-month lockdown ends, and there is a partial return to work in May 2020. There is an effective execution of government stimulus measures, reaching those who need it most, and avoiding allowing us to not see any social unrest. And the vaccine is announced, and consumer confidence rebounds sharply, and capital expenditures for corporates resume in the fourth quarter of 2019. So this is more or less the best case scenario. On the other hand, we have the U-shaped scenario, which I personally think is most likely going to be the case. A U-shaped recovery scenario assumes infection rates peak within the next 4 weeks from here on. 2-month lockdown and partial return to work for employees in June 2020. Effective execution of government stimulus measures. Bank performing loans rising to 4.5%. That's actually doubling, but still fairly manageable levels. No vaccine, but effective social distancing and normalization of the Philippine economy starting the fourth quarter of 2020. So, and under this scenario, capital expenditures for companies will be deferred until 2021. So let's look at the numbers for each scenario, the implied numbers for each scenario. For the worst case, or the L-shaped scenario, we see GDP growth drop, contracting by about 5%. Under this scenario, we also are assuming an ultra-conservative 40% decline in 2020 corporate earnings growth, or corporate earnings rather, no growth. So we've pretty much kitchen sinked 2020 earnings growth at minus 40%. If you recall earlier I mentioned our actual estimate is only minus 6%. But under the worst case scenario, we're assuming the worst, everything, the worst happens, and hopefully not, but under this particular scenario, minus 40% for earnings in 2020, and a modest recovery of earnings growth in 2021, 10% growth in earnings in 2021. Under this scenario, the market PER, fair PER, or price earnings ratio would likely be 12 times. And this derives a PSEI target of 3,960 under the worst case scenario, which I think we hit early this year, or was it 4,000? So this implies from these levels about a 30% drop in the PSEI from current levels under the worst case scenario. So actually, at the onset of this lockdown in the Philippines, we actually factored in what we, based on our assumptions, could be the worst case scenario for the Philippines. We're not saying it's not going to go back there, but if conditions for this worst case start emerging, there's a possibility that the PSEI goes back or falls 30% more or less to 3,960 based on this worst case. Now, the best case, on the other hand, wherein we ascribe a lesser probability, infection rates peak within the next 2 weeks from here on. We talked about that already. So based on that, we are looking at a GDP growth of about 3%, which is, I think, our current forecast right now, 2.6%. Earnings, corporate earnings for 2020 contracting by only 3%, and rebounding very strongly in 2021. Corporate earnings rebounding to 24% in 2021 on account of normalization and the low base of 2020. So up 24% in 2021. And under these conditions, the market PE could reach 16 times earnings, 2021 projected earnings, and that implies a PSEI target of 9,622 points. That's about 63% higher compared to current levels. So those are the worst and probably the best case scenario based on the information we have right now. Let's now go to the U-shaped scenario, which we think is the base case. This is the most likely scenario, and this is a scenario wherein we've ascribed a probability of about 70%. So based on the data right now, this is what we think will happen over the next over the next 12 months. So infection rates, again, peak in the next 4 weeks. There's a 2-month lockdown and a partial return to work in June 2020. Effective execution of government stimulus measures, bank NPLs double to 4.5%. Effective social distancing and normalization in the 4th quarter of 2020. More importantly, we're looking at under this base case or the U-shaped recovery, earnings growth declining by 15%. So again, I mentioned earlier, our research, our constant channel checks and meetings with our core investments over the past few weeks derive 6% contraction in earnings based on our financial models. What we've assumed here is we've assumed a margin for error. We've accounted for a margin of error, and we've assumed a 15% reduction in earnings for 2020, and that a 20% increase or rebound in earnings for 2021, based on the conditions mentioned earlier. And our view is that under these conditions, the market will trade fairly at about 14 times. It will reach it will likely reach 14 times earnings when things normalize, 14 times earnings in 2021, and that implies a PSEI target of 7,140, implying about a 20% upside from current levels. So this is a guide based on the prevailing conditions. So as we get more information, this is going to be our guide will help us navigate the uncertainty in the markets today and over the next 12 months. The strategy, the outlook is dependent on the shape of the recovery. Our view is there will be a recovery. Not sure if anyone thinks otherwise, but and the strategy is stick with your starters. We are positioning. We have and are continuing to position in high quality and still cheap, inexpensive blue chips. And our starting five, wherein we find meaningful risk return and upside, share price upside propositions. Ayala Land, BPI, Jollibee, SM Prime, and Ayala Corp are what we think are best of breed. And they anchor the strategy of capitalizing on price inefficiencies in the market. Hope we were able to shed some light on some fears and uncertainties in the market, and I think we're happy to take your questions. Thank you.
All right, thank you for your insights, June, and thank you once again to all of our speakers. Now we are opening the floor to a few questions from the viewer Antonio Munoz. Phil, maybe you can answer this. He says that he is pessimistic about a vaccine being developed within 6 months. Most likely, it's going to be in 12 to 18 months. What would be the scenario if this happens, but other optimistic indicators are realized?
I think I think we agree that any vaccine won't be available to the public for maybe till next year, early next year. But any development of this, an announcement of one, will certainly help sentiment. That's one thing that's impacting the market significantly. The vaccine will have very little to do with how the fundamentals will develop over the next 6 to 8 months. And we think that is where the concern of the market is at the moment. But I think the recent move of the market shows that sentiment has improved, primarily because one, there is a view out there that the quarantine will not be extended much further. And if that maintains, then I think the market will stay elevated, and we probably will not see the low of 4,000 that we saw earlier or late last month. So, you know, this next couple of weeks is going to be very important to see whether we in the Philippines at least have this crisis under some sort of control. We are certainly expecting the numbers to move higher, but relative to the number of tests we're doing, we don't expect the ratio to move higher. So that's something we're looking at. And as long as that stays where it is and not increasing, then my feeling is the market will continue to consolidate with an upward bias over the medium term. That can turn if the numbers turn worse. The vaccine issue is much more longer term. I think that vaccine will then allow people to kind of get back to normal operating procedure. What I mean by that is, you know, even without the vaccine, we don't expect malls to see traffic. We don't expect the travel business to be as robust as it was. We don't expect places like restaurants, like Max's, for example, or Shakey's, that a significant part of their business relies on parties. It relies on get-togethers. That will not materialize if there's no vaccine. I think that will take a longer time. So, you know, the vaccine is something that will change sentiment, something that will allow people to get back to their normal way of living and operating. And we think that for this year, it's going to be a reduced, no matter what, even if we get this virus under control, people will not be interacting like they normally did until there's a clearer path to solutions. So that's why we have a much more muted expectation for earnings growth for this year. It's coming back next year, but you'll see that it's really phased in. But once there is a vaccine and it's out there and we're confident we will have one, then I think, you know, large events, concerts, mall going, movie going, parties for families, that will happen again once a vaccine is in place. So I think that's the view that we have.
Of the benchmark to further lengthening or having a tactical play given the volatility?
Hello. Yeah. So, sorry, could you repeat the question? I didn't catch the first part.
Hey, for the ATRAM Total Return Peso Bond Fund, what has been the historical duration of the fund? Was the first question.
Okay. So first, thank you for the question. Over the last 5 years, on the track record I showed, on average, I would say that the average duration of the fund would gravitate between 4 and 5, although there were, of course, periods during which we would go below that or above that. A case in point would be in 2018, as I mentioned earlier, when inflation surged from 3% at the beginning of the year all the way to a peak of 6.7%. Our average inflation for that period up until the end of the third quarter almost was closer to 2. And that's why, as you can see from the graph of the returns there, even on the drawdowns that we experienced throughout the year, it was quite limited in nature still. An example of the opposite would be, well, of course, now, as I showed, our duration right now is above 7, given all the factors that I mentioned. So the positioning of the fund does change dependent on the factors that we see and the views that we take based on those factors. I guess that's why I mentioned that, my own bias aside, I feel that a total return strategy is the ideal type of strategy in investing in fixed income, just because a more traditional, let's say, tenor sliced fund, where a short-term fund invests in nothing longer than 3 years, and a medium-term doesn't invest in anything longer than 5, and a long-term invests in nothing but long securities, doesn't really give you the flexibility to adjust for shifts in the broad market conditions. Whereas, as you can see from our positioning, a total return strategy does allow that flexibility.
Okay, thanks, Miguel. There's a second question. Is
Sure.
it your view that the Philippine 10-year T-bond would go as low as 3 to 3.25? When was the last time this happened?
Actually, thank you for the question. I actually had that as my second to the last slide, I believe. The last time that the 10-year local GS bond was at around the 3.1% level was in 2016. At that point in time, we did have inflation that was a bit lower than where it is now. It was sub 2%. But it's worth noting that at that point in time, the policy rates were at 3%. And I believe the reserve rate at that point in time was between 16 and 18%. So quite a big difference when you think about where policy rates were. And given the view that there will be additional cuts to policy, given the view that inflation is likely to at least stay around the 2% level, or quite possibly move lower on the back of all the factors that we discussed, then I think it makes a very strong case for a return to those levels. Now, I don't have a crystal ball, so I can't say that it will get to 3.1, but I can say that given all the balance of risks and everything we've been discussing, it's not impossible. It makes a very strong case for it. And it's also worth noting that right now, the 10-year treasury is at around the 70 basis point level, or 0.7%. At that point in time, it was double that at 1.44%. So even if you assume that the 10-year Philippine bond moves to 3.1%, from a relative spread standpoint, it will still offer better value than it did back in 2016, because we don't necessarily see the 10-year US Treasury rebounding back to that 1.4 level. So quite a lot of value in Philippine yields still. And yes, simplistically, I do think that there is a chance we get back to 3.1%. So now would be a great time to come back in.
All right, thank you for that, Miguel. We have a question for equities. June, which specific stocks or sectors do you think will outperform in a post-lockdown economy?
Great question. I think in the post-lockdown economy, you'll have two phases. The first phase is still relatively a bit more defensive. People hiding in telecommunications companies where data usage is increasing, and consumer staples where people have been panic buying. They're anticipating how the panic buying will manifest or emerge in the numbers of consumer staple companies like Pure Gold and all that. However, as we approach what we think still is the best case scenario, wherein things start normalizing in the fourth quarter of this year, we think that the sentiment and the serious investors' money will probably go into those battered, high quality names that are going to emerge stronger under these circumstances. Stronger because they've tested their operations, stronger because they've realized certain efficiencies within their way of operating, and stronger because simply the competition is probably going to be weaker, because the weaker competition will be not as strong post-lockdown. So in that sense, we are looking at the likes of Jollibee, and the likes of companies like Jollibee, which post-lockdown are just plug and play. Faster recovery in terms of earnings, as all they need to do is open their stores. So those companies, we are a bit wary on the banking in the banking sector as we wait to see how this impacts asset quality. A 2-month lockdown impacts asset quality. We think it's a manageable situation for banks. unless the lockdown extends 4 months onwards, then things may get progressively worse. Yeah, so those are the sectors, I think.
Okay, got it, June. We have another question. Do you think the PSEI's recent rally is a bull trap, or is this the real thing?
Again, I'll revert to our compass, our map, which is essentially the U, V, and L shape scenarios. So right now, the data supports, at least from the data from what we're hearing from the government, the data from our channel checks with industry experts, with the heads of the companies that we invest in, the data from our channel checks from suppliers, distributors, industry thought leaders, customers. The data supports at this point a U-shaped recovery, and if it's a U-shaped recovery, we will still probably experience volatility because, as Phil mentioned earlier, our testing rates, the level of testing is increasing, and therefore you will most likely see a spike in daily infections. But under the U-shaped scenario, that spikes within the next 2 to 4 weeks. If that happens, the volatility will swing to the upside, and we think 20% upside on the market is possible. In the interim, though, as companies report weak first and second quarter earnings, that will probably trigger some bouts of volatility. But if you look at it 12 months forward, we think the market has 20% upside potential on the base case, and on the best case, it has 60% upside potential if a vaccine is announced within the next 3 to 6 months, and consumer confidence rebounds sharply. People might even start watching movies again, not on Netflix, but in the theaters. And right now, I think when we last talked about the market, when I last spoke in a webinar, the upside on Jollibee was 80%. Now it's smaller because of the sharp rebound in the market also. And I think the reason for that is when the scenarios pan out, there will be an increased emphasis back on company fundamentals, market fundamentals, and people will realize that the permanent damage caused by COVID-19 and the lockdown is fixable, or is something that has no permanent long-term damage on the economy. Yeah, so that's why we're confident the rebound is still in the works, and we think the best way to participate and in under these circumstances and to navigate is to invest in your starters or companies that have high quality, decent growth prospects, and will probably emerge stronger than ever. And companies who have treated their employees fairly well during this crisis. Certain companies have stood out, and there are companies who have made us look at them more closely. Yeah.
Okay, thanks for that, June. A third question is, when do you think we will go back to the 8,000 levels?
Okay. If there's a V-shaped recovery in the market, and again, caveat, we've assigned the lowest probability for this happening. But if infection rates peak within the next 2 weeks, there's a 2-month lockdown, and if there's a vaccine, it will likely hit 8,000 within the next 12 months. That's my call on the market. If we have under the V-shaped scenario, under the base case scenario, it will be more than 12 months. Most likely 18 months or 18 to 24 months. 8,000.
Okay, thank you for that, June. Great, so I think we
Welcome.
can wrap it up here. Thank you again to our speakers for presenting your insights and thoughts on the market. And thank you as well to our audience for tuning in and asking really good questions to our speakers. If you have any further questions or would like to learn more about ATRAM strategies, please get in touch with your ATRAM relationship manager. We will be sending the recording of this webinar to all of you, and we will also post this in our social media pages shortly. Again, thank you for joining us. And on behalf of ATRAM, I would like to wish you all the best of luck in traversing this market. Stay safe and have a great afternoon.
Thank you.
Thank you.